Hello guys, welcome to my channel ABC for derivatives. Today in this video we will be seeing options theory for professional trading and mainly be focusing on call options since being the first lecture of the series. Let's begin with history of derivatives. On the above side of the slide I have mentioned the history of derivatives globally, but we will be mainly concerned with the history of Indian derivative market. So the first derivative which was introduced in India was index futures, which was launched on June 12, 2000. In 2000, index futures were launched. In 2001, immediately after next year, index options were also launched. And after seeing that the options are very much useful in hedging and as demanded by many FIs and institutional investors, on July 2nd, 2001, stock options were also launched, and 9th November 2001 is the date when stock futures were launched. So the last from options and derivative markets has been traded from 2001 until today. So it's almost about 19-20 years since derivative market has been active in India. Let's see the parties involved in option trading. So there are two parties involved: option buyer और राइट बायर एंड ऑप्शन सेलर और राइट सेलर. तो दो ही पार्टी इन्वॉल्व होती है कोई भी ऑप्शन ट्रेडिंग में. एक ऑप्शन बायर होता है, राइट बायर होता है, या फिर एक ऑप्शन सेलर होता है, राइट सेलर होता है. अभी इनको बोलने के अलग अलग तरीके हैं. जैसे कॉल ऑप्शन बायर को बोलते हैं लॉन्ग कॉल या कॉल राइट बायर. कॉल ऑप्शन सेलर को बोलते हैं शॉर्ट कॉल, कॉल राइटर, कॉल राइट सेलर. जैसे पुट ऑप्शन बायर को बोलते हैं लॉन्ग पुट, पुट राइट बायर. पुट ऑप्शन सेलर को बोलते हैं शॉर्ट पुट, पुट राइटर, पुट राइट सेलर. तो ये अलग अलग नाम है, बट दो ही पार्टी होती है, दो कॉल की, दो पुट की. So let us understand how call option functions. So there are two friends, Karan and Rahul. Karan wants to buy 1 acre land from Rahul at a value of rupees 5 lakhs. So Rahul has a land of 1 acre which he wants to sell, and Karan wants to buy it at a value of 5 lakhs. Rahul is ready to sell subject to certain conditions. Now there is a probability that a new metro project is likely to be sanctioned near the land which Rahul owns. अभी सीधी बात है, अगर मेट्रो वो लैंड की जगह पर आ जाएगा तो लैंड का वैल्यू ऑटोमेटिकली बढ़ जाएगा. बट अगर उससे करंट को फायदा होगा. बट अगर वो मेट्रो का जो रूमर है, मेट्रो प्रोजेक्ट का जो रूमर, अगर न्यूज रूमर निकला, then in that case the investment made by Karan today will become worthless. So what should Karan do in this situation? Karan wants to play very smart, and therefore he enters into a special structure agreement which Karan believes is a win-win situation for both because now उसका दोस्त है. Details of the agreement is as follows. Karan is ready to pay an upfront fee of rupees 1 lakh today, considering this as a non-refundable agreement fee that Karan pays to Rahul. Second, against this fee, Rahul agrees to sell the land after 6 months to Karan. So in this case, Karan has made a non-refundable deposit of rupees 1 lakh. Second, Rahul has sold his right to sell the land to Karan after 6 months. Third, the price of the land after 6 months, which is fixed today at INR 5 lakh. Because Karan has paid an upfront fee, only he can call off the deal at the end of the 6 months and Rahul cannot. In the event Karan calls off the deal at the end of 6 months, Rahul will get the upfront fee. That is obvious. So in this case, Karan is a call option buyer or the right buyer. He has bought the right to purchase the land after 6 months at rupees 5 lakh, and for buying that land, he has made an initial investment of rupees 1 lakh. And in this case, Rahul is an option seller or a right seller. I hope these facts are clear to you all. You will have identified who is a call option buyer and who is a call option seller with the premium amount of rupees 1 lakh. Strike price or the future value of the land is determined today at rupees 5 lakh, and the agreement will end at 6 months. And the option to call off the agreement is only with the call option buyer, that is Karan, and not Rahul. So Karan can call off the deal. He cannot exercise the option, but Rahul, in case Karan exercises the option, will have to sell his land. Now after entering into this agreement, they will have to wait for 6 months to determine what actually happens. Now this will clearly depend on the metro project, and there are three possibilities which can happen. Once the micro project comes up, the price of the land will shoot up. Let's say it shoots up to 10 lakh. If the metro project does not come, the, the people are disappointed and the land prices crashes to 3 lakh. But there is a possibility that nothing can happen and the price remains at 5 lakh itself. So there are only three possibilities which I think. Let us remind ourselves that in the example which we are dealing, Karan is a call option buyer and Rahul is a call option seller. Now we will step into the shoes of Karan and think what he will do in each of the scenario. Scenario 1, where the price shoots up to 10 lakh. Current market value is 10 lakh. Sale agreement value is 5 lakh. This means Karan enjoys the right to purchase a land at rupees 5 lakh, whereas in the open market the sale is being sold at rupees 10 lakh. Clearly Karan is making a profitable deal and hence he would exercise the right and demand land from Rahul at 5 lakh, for which Rahul will have to sell its land at 5 lakh because he has entered into an agreement for which Karan has made a payment of rupees 1 lakh. So let's see how much profit Karan is making. So here's the math. Buy price of land is 5 lakh at the agreement fee. Remember he had paid earlier which was non-refundable. So the total expense which Karan has is 6 lakh. Current market value of the land is 10 lakh. Hence he is making a profit of 4 lakh in this case. Another way to look at this profitability is that for an initial cash commitment of rupees 1 lakh, Karan is making 4 times the amount. 4 times the amount. That is, for an investment of rupees 1 lakh, he has made a profit of 4 lakh, and exactly the profit of Karan will be exactly the notional loss of Rahul. Now in second case, if the price goes down to 2 lakh, current market price is 3 lakh, market value is 3 lakh, sale value is 5 lakh. This means Karan enjoys the right to purchase the land at 5 lakh, whereas in the open market it has been selling at a low value of 3 lakh. Clearly, it does not make sense to buy the land, and he will walk away from the deal because we will see the example calculation over here. Buy price of the land is 5 lakh and agreement fee. Remember, non-refundable fee of rupees 1 lakh. Total expense if he wants to buy the land will be 6 lakh from Karan, whereas in the current market value he is getting the land at rupees 3 lakh. So he won't pay. It is obvious that a rational person won't pay 3 lakh more just more because he has entered into agreement. In this case, since Karan has the right and he cannot he will exercise, he will lapse his right. I mean to say he will call off the deal. He will call off the deal and simply walk away. However, you have to remember that since Karan had entered into an agreement and he had already paid 1 lakh rupees, which Rahul gets in his pocket. So in this case, Karan will not exercise his right. He will let the call option lapse and he will incur a loss of rupees 1 lakh rather than incurring a loss of rupees 3 lakh. In third scenario, if the price stays at rupees 5 lakh, for whatever reason the price stays at rupees 5 lakh, in this case also it is advisable that he will walk away from the deal and will not buy the land, because if he buys the land, it will cost 6 lakh irrespective whether he buys it from Rahul or whether he buys it from current market. Because if he buys it from Rahul, he'll have to give more 5 lakh in addition to 1 lakh which he has given, and if he purchases from current market price, he'll have to purchase it as 5 lakh and 1 lakh is already paid to Rahul. So in its effective cost will be 6 lakh. So in this case, he will call off the deal and let go the agreement, for which Rahul will benefit from this deal because he will be getting 1 lakh and he can sell his land at 5 lakh and earn 6 lakh rupees from the entire deal. Let us understand. There are some FAQs which I would like to throw, which will help us to analyze why Karan entered as a call option buyer and why Rahul entered as a call option seller. The question number 1 asks, why do you think Karan took such a bet, even though knowing that he will lose his 1 lakh rupees if the land price does not increase? Agreed, but the best part in Karan's case is that he knows that his maximum loss will be of rupees 1 lakh only. There will be no negative surprise. And if the land prices increases, his profit will also increase. So, for example, in the case where metro project comes up, he will be making a profit of rupees 4 lakh on his investment of rupees 1 lakh, which is approximately 400%. Second question is, what circumstances will be a position such as current makes sense? In which case Karan Karan will be profitable. Karan will be profitable only in cases where the land prices uh, increases above the total cost. Total cost is 6 lakh. If the land price goes above 6 lakh, Karan will get profit. Under what circumstances Rahul's position will make sense? Only that scenario when the price of the land is less than or equal to 6 lakh. In that case, Rahul's position will make sense. Why do you think Rahul is taking such a big risk of selling? Because he could have a notional loss of rupees 4 lakh, and he will lose a lot of money if the land price increases after 6 months. Well, think about it. Answer. There are three possibilities. Statistically, if you see in, in the case one only Karan is winning, whereas in case two and case three, if scenario 3, Rahul is getting benefited. So statistically, the winning chances of Rahul is 66.66% as opposed to Karan. So on this basis, Rahul might be making a probable guess of being option seller. Let us summarize some important points of call option which we have discussed. This slide is very important, as this slide we will be discussing jargons of options. Now, in case number 1, Karan had made a payment to Rahul. This ensures that Karan has a right. Remember, the agreement can be called off only by Karan. Rahul cannot call off the agreement. That means if Karan demands the land, Rahul will have to has an obligation, and he has to honor the claim of Karan. Second, the outcome of the agreement at the termination at the end of 6 months is determined by the land. Without the land, the agreement has no value. Therefore, land is the underlying asset, and the agreement is called a derivative. So, in a derivative agreement, there is always an underlying asset. Now, take an example of stock. So, the call option or the put option or the futures of Reliance is an agreement, but that agreement is deriving its value from spot price of Reliance. So, in this case, the underlying in the case of Reliance, the underlying asset is the spot price of Reliance, and whereas the futures and the options agreement are called derivative instrument or derivative agreement. Now the agreement which has been entered by Karan and Rahul is an option agreement. Since Rahul has received advance from Karan, Rahul is option seller or agreement seller, and Karan is agreement buyer or call option buyer. The agreement has been entered after exchange of rupees 1 lakh. So in this case, 1 lakh becomes the option premium, at a premium amount to buy the right. Okay, very important thing very important or unique characteristics of derivative is that all the variables are fixed at the date of sale of the agreement. Okay, like for example, the area of land is fixed, the price at which the land will be sold is fixed, and the date of sale is fixed. The only thing that changes will be the underlying value of the land. As a thumb rule, in options agreement, the buyer always has the right and the seller has an obligation. This is very important. Last one. Now let us see. I hope you must have understand the basics of what is a call option. Now let us incorporate that call option into stocks. Assuming a stock is trading at INR 67 today, you have the right to buy a stock at INR 75 after 1 month. In order to get this right, you are required to pay a small amount today, say INR 5. An agreement of this sort is called call option, option contract, a call option to be precise. After you get into agreement, be a call option buyer, there are only three possibilities that can occur. Case 1, the stock price goes up, say 85. In that case, what will be your profit? The price at which the stock is brought is 75 because you have entered into the right to buy the stock at 75 after 1 month, for which you have made a payment of 5 rupees. So if the stock price is increased to 85, you will exercise your right and tell the option seller to give you the stock at 75. So the purchase price of the stock will be 75. Premium which you have paid for the right will be rupees 5. So the total expense incurred is 80. Current market price is 85. So you will be making a profit of 5 rupees. In case number 1, the call option buyer will exercise his right. In case number 2, let's say the stock price goes down to 65. Obviously, in this case, it will not make sense for the option buyer to buy the stock at 75 from the option seller and then sell it. Instead, he will rather buy it from the market itself if he wants to buy it. In this case, he will not exercise his right, rather he will let the option lapse and he will lose only 5 rupees in this case. In case 3, where the option price is 75. it simply means that you are spending 80 rupees to buy a stock which is available at 75. However, in this case, it is advised, it is better that I mean to say, it is in equilibrium position. Either he exercises his option and buy it at 75, with total cost will be 80, or if he purchases from the current market, and for which he'll have to pay 75. But however, he has paid a premium of rupees 5, and therefore his total cost will be 80. But if he doesn't want to purchase the stock, he might have just speculated that the price will increase. Then in this case, he will only use rupees 5. That is the option premium, and in this case, he will not exercise his right. The summary of the entire video is in this chart, and this, if you are a beginner, or if you don't know what the terms are exactly, the terms are called, so this chart will help you. Variable in the Karan and Rahul's transaction, the underlying asset was 1 acre land, whereas in the stock example, the underlying asset was stock. Do note the concept of lot size is applicable in options. So just like the land deal where the deal was on 1 acre land, not or less, options contract will be in lot size. Say for example, Nifty option contract trade in the lot of 75, etc. Expiry. Uh, 6 months was the expiry in the case of Karan and Rahul. So the derivative contract will expire after the 6 months. After the end of 6 months, they will determine whether they should they will settle the contract. Whereas in case of stock, it is 1 month. However, there are 3 expiries available: near month, next month, and far month. So, for example, or you can say current month, next month, and far month, or current month, near month, and next month. So, if I give you an example, today I am recording this video on 15th August. So, August is my current month or near month expiry. Next month will be September, and far month will be October. So, I have 3 contracts available for trading. Reference: in the case of land deal, it was INR 5 lakh, whereas in the case of stock, it was 75. This is also called strike price. Premium: in the case of land, it was 1 lakh. In the case of stock, it was 5 lakh. To note the stock market, in stock market, the premium changes minute to minute basis. This is very important, and we'll be covering it in a subsequent series of videos. Regulator. Now, this is very important. In Karan and Rahul's transaction, there was no regulator. It was based on good faith. Whereas in case of stock exchange is a regulator, NSE, BSE, and it is very important to note that all options are cash settled and no defaults have occurred. But now the options settle by now it is compulsory to settle options via so you have to compulsorily settle options through by paying by giving the stock delivery of the stock and by receiving the delivery of the stock. That will be covering in our subsequent series of the chapter. Thank you everyone for patiently listening. I hope this might have given you an insight of how how a call option is traded, either in stocks or in general also. Like for example, any commodity. Instead of land example, you can consider some gold or anything. To end this slide, I would like to just say this quote: the buyer of the call option is a right, but not the obligation to buy an agreed quantity of a particular commodity or financial instrument from the seller of the option at a certain time for a certain period. The seller of the option is obligated to sell the commodity or the financial instrument should the buyer so the buyer so decide. The buyer pays a fee called premium for this right. Thank you everyone for listening.